Well, hello everybody. Welcome back to Finspire's Focus on the Markets, third quarter 2026, America 250 edition. We're excited to get to it today. It's a hot summer and there's a lot going on and a surprising market, but also we have a lot to celebrate despite all the angst and turmoil around the world and in the country. So let's get right to it. As always, we're going to share facts about the economy, about the markets, and then also weave in our opinions about what's happening today and what to look forward to in the second half of 2026. All right, let's hit our capital markets strategy board. Okay. Wow. So the economy and the markets were the surprise of the second quarter. Rising resilience. You're going to hear that term a lot, both from me, from the financial press. A lot of that has been spurred by strong labor demand, but also strong manufacturing activity, which we'll get to in a little bit. And that allowed the Federal Reserve, despite the fact that there were higher energy prices, higher oil prices, higher short-term inflation, it appears they may stay put in terms of interest rates, and that allowed markets to really rally. Even though 10-year yield, for example, on bonds went higher in the second quarter, that did not deter the equity markets from making a really spectacular run in the second quarter. A lot of that was due to corporate earnings. We'll touch on that in a little bit. And then we have this big cloud hanging over the markets, and the market really surged through despite the geopolitical conflict overseas, complicating especially supply chains around the world of how to get energy transported into the right parts of the world and into different parts of the economy. Thus far, that has not deterred these markets, so it has been pretty remarkable. Although things are going to get a little bit tougher in Washington to get through, especially with the recent passing of Senator Lindsey Graham and a couple other aspects there that we'll touch on towards the end. Okay, so first trivia note, as you know, we like to do a few things, add a few nuggets of information in these videos. And did you know Ben Franklin preferred the turkey over the bald eagle as America's national symbol? I don't know. I think the bald eagle is the way to go. But great to see the turkey every Thanksgiving or so. A lot of fun there. Okay. This is what I mean by a resilient and very strong equity market. So when we started the year, the first quarter, the S&P 500 actually lost about 4+ % in the first quarter. And then the second quarter surge, which really took a lot of people by surprise. You can see that it was a 15.2% return on the S&P 500 in the second quarter. So just that 90-day period. And you can see here, these are the quarterly returns stacked from lowest on the left or worst to highest and best on the right. And you can see the 15.2% return in the second quarter puts it really in the top 8 or so of quarterly returns since 1988. So this was a movement of substantial and historic proportions. So it wasn't just the S&P 500. You can see these are year-to-date figures now, stacked 15 years, best performing to least performing asset class top to bottom. Interestingly, that 15.2% surge allowed the S&P 500 to finish the second quarter on a year-to-date basis as of June 30th, plus 10%. It wasn't just large companies, large cap US that rallied though. If you look at the top of the stack, you have emerging markets equities here up 24%, small caps up 22%, year-to-date commodities, which were surging, of course, and especially during the peak of the oil and gas movement during the Iran conflict. We're still getting some volatility there. It still matters. Overseas equity falling, I was going to say falling behind, but not really that far behind, still plus 10% nearly year to date, which is a fantastic figure. Bonds, however, have been flat. And I mentioned that the increase in bond yields put a little pressure on bond prices. Perhaps that will ease in the second half of the year, along with maybe a couple other areas of opportunity that we're seeing unfolding here in the second half. Okay, now why did this all transpire? Well, we had GDP growth in the first quarter of the year was positive 2.1%. But what was spurring that Ordinarily, it's consumer spending. Consumer spending really typically accounts for 2/3 to 70% of GDP growth. And yes, that was positive. That was positive 0.4% in the last reading. But really the big, or positive 0.4% contributor to that 2.1% in the first quarter. But the biggest driver and this is not only quarter of this year, but it has been true in a couple other in the recent past here. It's gross private domestic investment. So just think of that as company investment, okay? And because of the AI boom, because of the technology evolution that we're going through, we are seeing a greater and greater rebuild of tech stacks, basically, from all the way from, say, the artificial intelligence investments that companies are making, all the way through to all the software and the hardware necessary to make all that happen. And so that in aggregate has, and we've documented this in the past, is a massive amount of money. It's in the trillions that is being spent. And that is really what's driving economic growth. Now, that's also why maybe some of individuals, consumers, when they're surveyed, which we'll talk about in a moment, maybe don't always feel the connection between the growth in GDP and their potential future economically. We'll get to that in a little bit. But here is what is translating. That investment is translating into substantial economic manufacturing activity. So manufacturing, so the ISM, manufacturing and non-manufacturing indices, basically splits the economic data into two, manufacturing and services. And what has been, you can see here below this dotted line here, 50, which signals contraction. Above it signals expansion. And you can see manufacturing has been in contraction really for almost about the last 3 years, 3 to 4 years. Well, we got a big boost in those readings earlier this year, and it held. So it wasn't just a 1 month blip. It's turned out to be 4 straight months, 3 to 4 straight months of expansionary territory in manufacturing. And that is the other side of AI. So you need all these data centers. You need this build out in order to accommodate this technology evolution and innovation. You need the manufacturing build out to accommodate all that. Plus, you could factor in things like tariffs, et cetera, finally filtering in through things being made here in America as opposed to elsewhere. All of that's contributing to positive and expanding manufacturing sector. All right, first capital of America was actually New York City, believe it or not. George Washington took the presidential oath there in 1789, and Statue of Liberty eventually arrived as symbol of freedom and hope, a gift from France in 1885. So a little mini New York history there. You'll notice that George Washington took the presidential oath there in 1789. Yes, we declared our independence in 1776. But that doesn't mean that wasn't the end of the fighting of the Revolutionary War. It actually didn't really cease until 1781 after the Battle of Yorktown. So anyway, a little New York and American history. All right, we get to the unemployment picture. The labor market has been pretty resilient. Again, I'm using that word resilient. It has been steady. We had 1 month early this year where we lost jobs. We've gained since, somewhat to the surprise of prognosticators, economic prognosticators out there. So the unemployment rate remains quite modest. 4.3, it dove to 4.2% in the month of June. Wage growth has been in that area where it's still growing, but the rate of growth is decelerating a little bit into what we would consider a sweet spot for corporate earnings, which is between that 3 and 4% range. And the concern here is, well, is it going to keep up with inflation, right? You always want wages to keep paying. Sometimes when inflation spikes and wage growth has to spike with it, that can deter from corporate earnings. However, we're in that area where, because inflation appears to now to be, this recent spike in inflation appears to be short run, potentially short-lived, at least for now, that wage growth is very healthy, not only for consumers, but also for employers, which is that sweet spot. Now, I mentioned earlier, why are consumers not feeling the benefits of GDP growth, why they think they may not be feeling it. And that shows up in the data. So the University of Michigan has conducted a survey of consumer sentiment for both current, how people feel today, and what their expectations are in the future. And it's at the lowest level it's ever recorded. consumer sentiment. This is lower. You can see down here, average sentiment's up here about 83.8. We're down in the 40s. That's lower than where we were during the great financial crisis in 2008, 2009. So people are in a really sour mood, and there's a whole bunch of things that go into this, into how you feel, right? It could be politics, it could be your job security, it could be your income, it could be wages, it could be inflation, it could be a whole number of factors. But current conditions, which is how do people feel today, at its lowest level ever recorded. Now, ironically, at times, although not all the time, in many respects, consumer sentiment at these levels is actually bullish for markets because people are so pessimistic that it can't get any worse. But it is something worth noting because it also reflects the mood in the country. It also reflects the mood of the country. Now, here's what's amazing, and here's really what's been driving the equity markets higher has been corporate earnings. It's been a whale of activity in the first quarter of the year. The corporate earnings numbers well surpassed expectations. We've had innovation all over the place. We have large private companies going public like SpaceX. It's just amazing because in the US, we are the hotbed and the home base for ingenuity, innovation, technology advancement. Just look at everything, and we just take a look at the Wright brothers. The Wright brothers in 1903, right, achieved flight in Kitty Hawk in North Carolina in 1903, all the way to the moon landing in 1969 by Apollo 11. To today, we're doing space exploration and talking about putting data centers up in space. It's pretty remarkable, and this is 123 years after the Wright brothers achieved powered flight. We're talking about doing things on Mars and in space that we were seemingly incalculable, unimaginable, but are real. And it just reinforces that the biggest driver of innovation in the world is right here in the U.S. economy. And we shouldn't forget that. All these accomplishments and advancements in technology are attributable to American ingenuity. And this is what I'm talking about. So we've shown you this chart before. We have the movement of the S&P in the jagged blue line. We have the earnings of the S&P 500, corporate earnings in the mountain blue, in the blue mountain in the back. And I mentioned in the first quarter and the previous quarter videos, stocks were expensive, meaning from a price to earnings ratio, stocks were expensive. They can stay expensive. Believe it or not, from the end of the year, so fourth quarter earnings to first quarter earnings, which were released in April and May and parts of June, despite the fact that market prices in the second quarter went significantly higher, as we documented, earnings grew faster than prices. So as a result, when you look at those ratios, where the market actually is less expensive today than where it was to start the year, despite the fact that we've had 15% run up in equity prices in the S&P 500 in the second quarter of the year. So what we always look for is this S&P 500 movement. Is it line? Is it going to exceed the blue mountain in the backdrop? That usually tells us that stocks are really too expensive, really too far expensive. But actually, because earnings grew so fast in the first quarter of the year, you can see the blue mountain in the background here actually spiked higher than the movement of the S&P 500. So it makes for very interesting. Are stocks still expensive? Yes, but they will be until earnings disappoint. But we haven't seen that yet, and that's what's been driving such strong returns. And it's in a diversified fashion. So because of where the economy is, because we looked at how small caps and emerging market equities and even overseas developed markets are doing well in terms of stock prices, diversification is very important, not just geographically, but also by sector. It's not only a tech-led rally here. If you look at just the sector returns over the last 12 months, ending June 30th, yes, technology was up 36%, but look at some of these other big double-digit gainers. Energy, for example, even healthcare, which had been lagging, is up 17-18% over the past 12 months. So diversification is not just a geographic issue. It's also looking within your U.S. portfolio and say, gosh, I don't have to have all my money in technology. I can look at some of these other even more value-oriented traditional sectors of the market and say, yeah, there's opportunity there as well. Okay, so we mentioned bond yields. Okay, bond yields have moved higher, and this was one of the bigger surprises in the second quarter. Not the fact that bond yields moved higher, even though at the start of the conflict in Iran, you would traditionally think that bond yields would go lower as a fear trade. In exchange, and instead, what actually occurred is bond yields rose, and they rose in correspondingly with rises in energy prices, which was predictable after the conflict began in Iran. What has taken the markets a little bit by surprise here is that it's possible that these bond yields are rising due to future potential for better than expected growth, as opposed to maybe higher than expected inflation. Maybe it's a combination of the two. Maybe it's also for some other reasons, which I'll talk about in a moment. But you can see that across the board, we had an increase in the yield curve from short term on the left to long term on the right. All eyes and attention are on Kevin Warsh at the Federal Reserve to see what he's going to do with that very short end of the curve. But you can see the rest of the curve has moved higher along the way, which has put pressure on bond prices. But surprisingly, it did not take the wind out of the sails of the equity market, especially in the second quarter. All right, let's take a quick little break here. All right, did you know that the White House wasn't always white? I didn't know that. In fact, after the fire damage during the War of 1812, it was then painted white. The White House was then painted white. But there's another, you'll see a picture here related to the War of 1812, and sure, Uncle Sam, right? That's become a moniker that people are familiar with. Uncle Sam over here on the right. No, he's not a famous landmark, but he's got a great story, and it does relate to the War of 1812, ironically, which is something referenced here about when the White House was actually painted white. Well, there was a gentleman, a meat packer, actually, by the name of Samuel Wilson during the War of 1812, who was supplying barrels of beef to the U.S. Army. And he marked the boxes, those barrels, he stamped them U.S., meaning property of the U.S. government is what his intent was. Well, when the soldiers received the barrels of meat, they actually joked and thought it was, well, that came from Uncle Sam, meaning Uncle Sam Wilson. Well, anyway, that joke, I guess, or that amongst soldiers actually stuck. But it took all the way until 1917 until the Uncle Sam Wants You poster for the U.S. Army became famous. But that is the history of, the brief history, I should say, of the term Uncle Sam. It actually arrived from a meat packer from Troy, New York, named Samuel Wilson, who was supplying the U.S. Army with beef during the War of 1812. How about that? All right, so let's talk about Washington, D.C. Let's talk about the White House. Let's talk about policy decisions and how it could impact markets. We've shown this chart before. It's a little bit of a scary chart. This is projecting out future interest payments on the debt, and both as in raw dollars and as a percentage of the economy. You can see they're both running, these dashed lines here are both running somewhat parabolically higher, which is going to create, we've talked about this, it's going to create some challenges for policymakers in Washington, D.C., for bond yields. Another reason why bond yields might be moving higher is because the unfortunate part about this, it was that we were making, before the Iran war, we were actually starting to make significant progress towards chipping away at the size of the U.S. deficit. So it was actually trending and moving significantly in the right direction. Then the war broke out, and then we had these supplemental spending packages, and now the White House actually suggested a $1.5 trillion defense package for the National Defense Authorization Act that is due by October 1st for the next fiscal year. So a lot of the progress that we made, there's still some progress that has been made on the deficit, but some of that's being taken away from increases in defense spending and some of these intermediate term resolutions required to keep the ammunition's flowing for the War Department. So this was a little bit of a bummer. It is a risk to the economy. Of course, gas prices. When I mentioned earlier about how people feel, people can get pretty ornery when gas prices are high. I'm the same way. We all are, right? But gas prices aren't just driven by crude oil prices. They're also driven by other factors, which you see here in the beige, which could be taxes, it could be refinery costs, shipping costs, etc. And that can be a big contributor. Also, it's been found that gas prices have a big impact on the way people vote. All these things, which we'll talk about in a moment, all these things, gold has lost a little bit of its luster as of late, even though it's been on a really big tear over the last 5 years and caught up to the value of the S&P 500. When you compare them in terms of total return, cumulative return since 2007, it was pretty significant how far gold lagged the S&P 500 up until recently. And then very recently in the second quarter, because with the big surge in equity prices, gold prices actually went down for fear that we were going to have runaway higher interest rates as a result of the conflict in Iran and also rising energy prices. Now, that could mean that although gold has lost its luster in the short run, maybe it's just taken a breath after such a significant run and it's ready to resume its rally. It's very possible, especially if we continue to get good inflation news along the way. Okay, so let's summarize everything. Despite all of the geopolitical conflict, markets climb that wall of worry like nothing we've seen in a long time, in multiple years for one quarter. Much of that was driven by earnings. Can that continue? It's going to be a challenge in the second quarter for sure, but it could. I mentioned stocks are expensive. They can remain expensive for an extended period of time. But diversification is working again. All right, for about the third straight year now, we're looking at a year where you don't have to rely just purely on U.S. large cap technology stocks and the U.S. large cap index, say the S&P 500. Other opportunities, other diversification opportunities are there across market capitalization, geographically, et cetera. And look, it is possible. Geopolitical events overseas are still impacting things like oil prices. Oil prices are still jumping all over the place. They can impact interest rates, which can then impact the movement of the equity markets from day to day. Then you throw in the short-term issues in Washington, D.C. about the death of a senator. You could have some things that are might not move through Congress that you might expect, especially in a midterm election year where markets typically are a little bit sluggish until after everything is sorted out in November. But it's going to be a hot summer, not just here, but in Washington, D.C. All right. Just want to say thank you. Thank you for watching again. Thank you to the country. This has been a remarkable World Cup. I've got my America 250 shirt on. There's still, despite all the things out there in the world that drive a lot of consternation and concern, there's a lot that's going right here too. Notably, the World Cup. Right? What an incredible summer. I hope you enjoy the Spain-Argentina final. It's going to be amazing. But it was great to host everybody here in the U.S. across all these cities. I was captivated not just by the games, but also by the coverage of the visitors, of everybody from these countries coming to the United States. But you know what? It doesn't really surprise me. It just reinforced what I already believed. This country was grateful enough to welcome my father as an immigrant back in 1958, my mother's grandparents back in 1907. They didn't come with much of anything, and America represented that opportunity. And now America is representing that, not just opportunity, but also that interesting way of that culture, and that culture that we've been able to share with everybody from around the world visiting for the World Cup has been really fun and captivating to watch. Thank you for listening. Plenty to celebrate with America 250. I know there could be some down days, but there's a lot of things going right here. Thanks for listening. We'll catch you next quarter.